Hello everybody, it's Yashar here, back again with another video, and in this video I will cover earnings report of Enbridge which was released a few days ago. I will also update my evaluation of Enbridge stock with the new discounted cash flow calculator and the new financial data we received recently. There's a lot to cover today, so let's jump right into this. For those of you who are not familiar with Enbridge, Enbridge is a giant energy infrastructure and energy transportation company with massive footprint in Canada and US, which has 5 divisions. Liquid pipelines, which is the most important source of cash flow for the company, gas transmission, gas distribution and storage, renewable power generation, and energy services. The firm's most important asset, its mainline system, controls over 70% of Canada's takeaway capacity and is linked to US refineries, meaning demand remains secure in the near to medium term despite the increase in the US light oil production. It's also important to note that over 80% of Enbridge EBITDA is protected against inflation and around 2% of EBITDA is only sensitive to commodity prices. The stock is paying a huge dividend with a starting yield of 7.35%. And if you look at the history, they have 28 years history of paying and increasing their dividend every single year with a 10% average year-over increase in dividend and almost 12% combined return with capital appreciation, which is an absolutely amazing track record, considering how many financial crises and stock market crashes we had in the past 28 years. And Enbridge were able to continue to pay and grow their dividend payouts in all these financial situations. They also guided for an almost 5% growth in their EBITDA in the next couple of years, which comes from optimizations, pipeline expansions, growth in their renewable business, and reducing costs and share buybacks. These are all positive points, but on the flip side, due to its size and public profile, Enbridge is the center of attention for ESG-related legal and stakeholder challenges across its assets, including Line 3, particularly Line 5, and Dakota Access Pipeline. Another risk with this business is their move to renewable energy business. Enbridge has yet to build a profitable and multi-renewable business, which means they are currently risking their capital investments with this unknown profitability yield over the next few years. With this information in mind, Enbridge reported their earnings a few days ago, and overall, it's an okay earnings report. I think all the numbers are in line with expectations. Their adjusted EBITDA is growing, but I think we should not really look at earnings for a business like Enbridge. Their distributable cash flow, which is a better measure of their business success, is also growing, but with an extremely slow pace, which is a little bit concerning. My overall issue with Enbridge is that they're not really growing much when you look at the cash flow. Their guidance for cash flow growth is around 3% year over year for the next couple of years, which is really slow, and I cannot predict their future cash flows with 100% certainty due to huge number of lawsuits and ESG related issues with their critical assets. High carbon emissions associated with the full cycle of oil sands production, which is one of the main Enbridge assets, is a major risk if countries and governments continue to seek ways to reduce greenhouse gas emissions in future via more, for example, carbon tax. That's the reason market is not giving them much of a premium despite their strong underlying business. Now let's use the updated financial information from this report and plug them into my new discounted cash flow calculator and find the fair value of the stock. To start building the model, I imported a series of general parameters from Enbridge earnings report like the current share price, their revenue, their number of shares, their net debt, which is their short-term and long-term liabilities minus their cash or cash equivalents, and their distributable cash flow per share. I also put my expected rate of return to be around 10% for this stock. Now in this model, I will calculate the fair value of the stock by projecting their future cash flow and then discount the terminal value and future cash flows minus the liabilities of the company back into the present value of the stock based on 3 different scenarios. In the bear case, or the most negative case for the stock, the business will have a little bit of margin compression. I consider them to dilute you to raise capital by 1% and be able to grow their revenue by only 2% in the short term, 3% in the midterm, and eventually by only 4% in the long term. And I consider the terminal multiple of 8, which is in agreement with historical bear periods of this stock. For the base case or normal case, I considered a little bit better margins in line with their historical average, a little bit better revenue growth, and a terminal multiple of 10, which is historically an average multiple for a similar stock. Finally, in the bull case or best possible outcome, I considered a little bit profit margin expansion, a 5% short-term, 6% mid-term, and 7% long-term growth, and a terminal multiple of 12, which is a bull multiple for this company. Now, if I hit calculate, the software will give some valuable information about this stock based on my assumptions. First of all, the software reminds me that this business has a lot of debt in balance sheet, so it is wise to increase my expected rate of return to increase my margin of safety. Let's ignore this message for now. It also gives you the intrinsic value of the stock in each scenario, and then it will provide you with a fair value estimate, which is around $40 per share for Enbridge, and comparing to the current share price, Enbridge trades at a 20% premium today. It is not a buy according to the model. So for me, Enbridge is a great business, but it has three major issues: slow expected growth, high debt, and a lot of ESG related issues. I would not buy the stock at this level, but I don't think I can receive because I don't think I can receive 10% compounded return over the long term at the current share price. But it all depends on your expected rate of return. If I change my expected return to 7% in this model and hit calculate again, the stock is a buy today. So if you buy Enbridge for its dividend, then it might be a good option depending on your investment goals. There you are, guys. I hope you enjoyed the video. And if you enjoyed the video and my coverage of earnings report of Canadian companies, consider subscribing to the channel to see similar videos. I will wait for my other Canadian companies' earnings report to hopefully cover those as well, including Brookfield Corporation. But until that time, I see you guys in the next video. Farewell.